A really good idea is to have a reason for owning the investments in your portfolio, and the reason will usually be that you expect to do better with what you own than by owning something else. This applies to direct investments as well as to managed funds. So if you're going to invest money in shares, should you keep all of your money in Australia or put some of your capital offshore? After all, shares are shares, regardless of where they are, and the argument you should have investments in Australia and overseas for diversification reasons is a little bit fatuous. There are tax advantages in owning Australian companies because you get franked dividends, and this can add 1 to 2% each year to the investment return. But there will be times when you might expect a better return overseas, even taking these tax credits into consideration. The green line shows the total annual return from the Australian share market. The blue bars show the total annual returns from international share markets designated in US dollars. These are the native returns, if you like, where the value of our currency compared to overseas currencies isn't a consideration. There's a 90% correlation between these returns, meaning they generally move in the same direction. There was a time in the late 1990s where international markets outperformed Australia because the technology boom boomed more overseas than it did here. And then the effect of the tech wreck between 2000 and 2002 was greater overseas than here, and international markets did worse than Australia, although the international markets bounced back strongly in 2003. From 2004 to 2007, Australia did well due to the resources boom, and share markets both here and overseas have been volatile for the last 5 years. We don't seem to have an investment bubble overseas at the moment, and it's pretty much universally acknowledged that the construction phase of the resources boom is over. Our view is that economic growth may be stronger overseas than here in the next few years. The other thing to bear in mind is the impact of currency movements. The light blue bars show the changes in the value of the US dollar. And since the dark blue bars show the international returns in US dollars, Australians who invested overseas actually got the returns shown by the blue line, reflecting both the international market returns and changes in the value of the currencies. You make more money from international investments when the value of the Australian dollar is falling, and that's what we expect to happen. Throughout much of the past 10 years, investing in Australia has provided superior returns, but the circumstances that led to that outcome no longer exist. So increasing your international exposure might be a sensible thing to do. The other thing you can do if you think the Australian dollar is likely to fall is to own shares in companies that earn revenue in foreign currencies. Australia has good multinational corporations and their share prices suffered when the Australian dollar was flying high. They'll benefit from stronger economic growth internationally. They've already done quite well due to the fall in currency last year, and we expect this will continue. Inflation in Australia is quite low at the moment at just over 2%. It may well stay low, but we think there's a real chance of a spike of inflation over the next few years. This chart compares the real interest rate, that's the interest rate above the rate of inflation, with the rate of inflation each month over the past 20 years. It's the rate of return after inflation that really matters, and what the chart demonstrates is that over the past 20 years in Australia, it's been harder to get a real investment return when inflation rises. We think it's going to be even harder from where we are now with a low inflation rate and record low interest rates. I'd like you to consider two scenarios. Scenario one is that inflation over the next 10 years remains roughly where it is now. If that happens, the consumer price index will go up as indicated by the blue shaded area, and prices will be about 25% higher in 10 years' time than they are now. The second scenario is that we have a spike in inflation that stays high for a little while before coming down again. The green area shows the consumer price index that would result, with prices being just under 60% higher in 10 years' time than they are right now. So what are the options? You could buy a 10-year Treasury bond and get an interest rate of a little over 4%. At the end of 10 years, you'd get your money back. If you invested $100,000, then over 10 years, the income that you would receive would be $42,000. Alternatively, you could invest in an indexed corporate bond. The current yield's a little less than you'd get from a Treasury bond, but it'd increase each quarter in line with inflation. Over 10 years, the income will be much the same, but there's another factor at play. As well as the income being indexed, so is the value of the bond itself, and over the 10-year period it had increased in value by almost $30,000. So over 10 years your actual return would be $70,000 rather than $42,000. Now you should bear in mind that there's more risk involved. The corporate bond doesn't have the same credit rating as the Australian government, although you can select bonds issued by significant infrastructure suppliers or operations with government guaranteed income, so the level of security is quite high. The other risk is that you're buying on the market and market prices can move about, but if you're getting a decent interest rate there's no real need to sell at a bad time. The real magic comes if inflation should spike. If this happens, the income you'd receive goes up as demonstrated by the green line, and the capital value goes up as shown by the green shaded area. Your total return over 10 years will be close to $100,000. The message is you can get excellent inflation protection at almost no opportunity cost. In other words, you won't be missing out on the income you're currently receiving in order to get inflation protection. An interesting strategy is to blend an indexed bond that goes up in value with an indexed annuity that pays a higher income but goes down in value over time. The idea is that you get your money back as you would from a normal fixed interest but get a higher cash flow from the very start that's indexed to inflation. If inflation remains low at 2.5%, you'd expect to get around $18,000 more in income over the 10-year period and also get your $100,000 back. This is quite a good reward for the relatively small amount of additional risk that you're taking. The real benefit is that you have protection against a spike in inflation. Not only will you get indexed income, but in this scenario you'd also experience a capital gain, so the total return would be over double what you'd expect to get from a traditional fixed interest investment. Corporate bonds are acquired on the corporate bond market and they can be bought and sold at any time. As with treasury bonds, you don't need to hold them for a 10-year period. Thinking about Australian investments, a significant event has been the change of government. We believe investors generally will be beneficiaries of the change in government. The large mining companies will benefit from the abolition of the mineral resources rent tax. But that's not the only thing they have going for them. The construction phase of the mining boom is certainly over, but the supply phase is still going. The volume of raw materials required by China in particular will increase inexorably. And even if commodity prices fall in US dollar terms, the resulting drop in the value of our currency will mean that commodity producers will receive very attractive income in Australian dollars. The major beneficiaries of the abolition of the carbon tax will be the traditional energy producers. AGL Energy could be a special situation. They acquired the Loy Yang power station fired by brown coal from southeastern Victoria for a song when the carbon tax was introduced, and now they have a cheap asset that will generate excellent profits in the future. With an anticipated grossed up yield of over 6%, AGL is set to provide good and probably increasing income even if the bonus from the abolition of the carbon tax doesn't eventuate. Finally, it's worth spending some time thinking about where the Australian economy is likely to turn for economic growth as we transition away from building new mines and mining infrastructure. The current candidates are the home building industry and tourism. Growth in both of these sectors will be good for the whole economy. They're both labour intensive and that should help with employment. And building new houses has a multiplier effect, with each new home needing fixtures and fittings along with a wheelbarrow and a Victor lawnmower that's still manufactured right here in Australia. The logical reaction to a projected lift in home building would be to buy the major supply firms like Boral, the building material supplier, and GWA Group, who supply fixtures and fittings for bathrooms and kitchens. There are two major problems with this idea, and I suggest you take a look at the presentation on investments to avoid. A boost of tourism is a little hard to take advantage of. A lot of the benefit goes to small private enterprises or large overseas hotel chains. The best barometer to tourist activity is movement through the airports, and this is where investors may be able to pick up a benefit from this theme. Sydney Airport is the largest airport in the country and it's widely regarded as the gateway to Australia. The investment benefits directly from increases in passenger traffic because they charge a fee on every ticket. They can charge more rent to all the shops and bars at the airports because there are more passengers, and they pick up extra from charges to all the services that pick up and drop off passengers at the airport. Considering home building, We prefer companies like Wesfarmers and Lendlease. Wesfarmers owns Bunnings, which is the major hardware chain in Australia and a leading supplier to home builders. While Wesfarmers' share price has run up quite a bit in the last year, it's still at quite reasonable levels. Lendlease are major builders of residential properties, commercial properties and infrastructure. It remains busy throughout the business cycle, but potentially gains significantly from growth in the housing sector, not just because they're building the apartments and the houses, but because they also build the schools and the shopping centres that are required to support them. So review your portfolio with Middeltons Securities and invest for a reason.